What's up everybody, Nate here. And the most recent job numbers for April 2023 came out today, and at a glance it looks like the labor market in the United States is really healthy. The jobs market added around 250,000 jobs last month, and wages actually increased across the board by around 0.5%. This is all of course after Federal Reserve interest rate hikes and a slowing economy where consumers don't have as much confidence in their spending as they did in 2022 and in 2021. But while at a glance the labor market looks really healthy in the United States, economists and experts alike are kind of worried about what could potentially be looming over the market in the future. And there are three major things that could end up crushing jobs growth in 2023 and beyond. The three things that are affecting the jobs market right now are productivity, you have the Federal Reserve, and you have the potential debt default from the United States federal government. Productivity is something that is measured on a company by company basis, and it basically shows that productivity is going down on a month-over-month basis. So companies are having a really hard time getting their employees to produce what is needed to sort of make our economy successful in 2023. Now, normally this wouldn't be a huge issue because you'd have a lot of economic expansion and you'd have a lot of competition and a ton of other businesses sort of filling in the gaps. But in 2023, we have a little bit of an issue with businesses growing. While we did add around 250,000 jobs in April of 2023, we also laid off around 175,000 workers, and potentially we could continue to see more layoffs and more unemployment throughout the rest of this year. But when it comes to productivity, this is something that businesses simply can't ignore in 2023, and it's sort of a rotating problem. Businesses employ Americans, and there are two major ways that businesses get money. They can get money through investor interest, and they can get money through consumer spending. Well, because inflation has been really highly elevated over the last year or two, well, consumers aren't spending as much. Not to mention, wages have not gone up to meet where inflation is at, so consumers have all of their money losing value, which again means they can't spend as much money. That hurts corporate profits, and that hurts businesses' ability to hire people and retain people and to give people raises. But then you have the other side, which is investor interest, and because businesses are struggling with consumer spending and there is this big slowdown in consumer sentiment, meaning consumers feel like they're not going to be able to buy as much in 2023 and beyond, well, that means investors have been getting a little bit scared and they're not investing as much as they were in 2022. But that's not all. Typically, even when you see an economic slowdown, investors are willing to bet on companies and the United States economy in the long term, so they continue investing no matter what. But because of our economic conditions and really high interest rates, investors don't want to really put as much money into businesses or any other investment right now, fearing that they could lose it all. It has become extremely difficult for investors to make a huge return on their money in 2023 because interest rates are so high. So they have to make a much larger return over what that interest rate is. Bottom line here, if they can't borrow money very cheaply, then that means they're not going to. And if they're not borrowing money to invest in companies, then companies lose a lot of that liquidity. This is why we've seen the stock market go way down in 2023. And it's for the same reason why we've seen businesses have all of these cutbacks. So those are the two reasons why businesses are sort of getting hit from two fronts right now. So businesses at the end of the day are getting hit with their profits in two major ways. And so what they need to do now is try to figure out how they can do a lot more with less. But this has become difficult because productivity is going down month over month. Meanwhile, businesses, because of things like the Great Resignation and the anti-work movement and businesses just trying to hire a bunch of people to cater to demand in 2021 and 2022, well, they gave out huge raises. Not to mention inflation was so high, they had to give out raises in order to incentivize people to come to their company. So businesses have lower productivity, meaning that they have lower merchandise, they have lower sales than what they had before. Meanwhile, they have a higher payroll than they had before, even though they have less employees, which could lead to even more layoffs because they want to try to find some way to make a profit in 2023, and they have to do this in order to look good to the shareholders. Now, the second thing we need to talk about here is the Federal Reserve. Now, the Federal Reserve has a massive impact on the labor market with its monetary policy, and that means its interest rates. When the Federal Reserve raises its interest rates, well, that makes it a whole lot harder for investors and consumers and businesses to borrow money. So that economic expansion really isn't going to be as large as it has been in previous years, all because Federal Reserve interest rates are much higher than they usually really are. It's one thing to not get investor liquidity because investors are sort of scared and don't want to spend a lot of their money right now and don't want to take on debt themselves, but it's another thing when all of this corporate debt for a lot of your big corporations starts to get a whole lot more expensive, and that is what we're seeing in 2023. A lot of businesses who took on big expansion projects over the last couple of years because interest rates were low now are having to pay a whole lot more money on that debt because it comes at an adjustable rate through the Federal Reserve. And the rate at which corporations pay back that interest is going to fluctuate based on how high or how low the Federal Reserve sets its interest rates. Well, so now businesses have pretty much stopped taking on debt altogether, but all of the debt they already have is getting a lot more expensive to pay off, and that is also eating into profits. We've seen companies like Bed Bath & Beyond and Home Goods and even Walmart decide that they're either going to close all of their stores or just a portion of their stores in 2023. This has a lot to do with that corporate debt. There are a lot of companies out there that are necessities, like grocery stores are necessities. Walmart sells things that people are going to need no matter what the economic times are, and they keep their prices cheap and really low, but despite that, they're still closing stores because they have a lot of debt that they need to pay off, and it's getting really difficult to. Not to mention, even though you've had 250,000 jobs created in April, well, that doesn't mean that all of those jobs are going to stick around for an entire month. In February and March of this year, we had really robust job numbers and they were really highly elevated. However, a lot of those job numbers were actually estimated to be a whole lot lower a couple weeks later because a lot of businesses either pulled those job listings or actually cut those positions, realizing that they can't have them because they're too expensive right now. And the bottom line here is the Federal Reserve is looking at our overall economic trends because right now you have an unemployment rate of around 3.4% and you have a jobs market that is adding around 250,000 jobs every single month. In the Federal Reserve's eyes, that is way too much. One of the Federal Reserve's main jobs is to ensure maximum employment in the United States, and that means that in their eyes, there is a maximum amount of people that can be working in the US at all times. Federal Reserve believes we are way over that number. Unemployment is way too high, so if we continue to see too much job growth, that means the Federal Reserve could continue to raise its interest rates because it wants to soften the jobs market. It believes there's way too many jobs out there, and in its eyes, if there's way too many jobs out there with people making way too much money, that means inflation is going to continue to go up because you have so much demand but not a lot of things being made. The Federal Reserve estimates that around 3 to 5 million jobs could be immediately eliminated if they continue to raise their interest rates, but that would bring down inflation, which is their overall goal. And lastly, number 3, you have the debt ceiling and the debt default problem for the federal government. Now, if you haven't been following along with this issue very closely, basically what's happening here is the United States has a maximum amount that it can borrow over a certain period of time. So it can only create so much money, it can only borrow so much money before Congress either has to raise the debt ceiling or it goes into default or it has to find some other way to pay its bills. Well, as of June 1st, Congress hasn't voted to raise the debt ceiling and the federal government hasn't really found any other way to pay back its bills, meaning the United States government could end up defaulting, and that could have catastrophic consequences for our entire economy. President Biden actually said today that job growth could go to 0 if the federal government does not pass a new debt ceiling. So this is a pretty serious problem just in general, because what it could mean is the Federal Reserve actually has to raise interest rates even higher than they anticipated because they want to make sure that the US dollar is really strong and that people around the world want to continue to use it. If the United States government defaults on its debts, well, that means it's not going to be paying all of its bills. So that means that people around the world, other governments, other agencies, well, if they have United States debt, they're no longer going to be getting a payment, which means they don't want to hold on to US dollars anymore, and that lowers the value of US dollars. So what the Federal Reserve could do is raise their interest rates really high, so that way the dollar is really strong, because now it's really difficult for businesses and governments across the planet to access US dollars, making them rare. But that could also have catastrophic consequences because now you have businesses who cannot get US dollars. You can't borrow any money because it's really expensive to do so, and all of that government debt and all of that corporate debt is extremely expensive to pay off, meaning a lot more layoffs. Not to mention all of the government contracts and all of the projects throughout the entire United States or world that rely on that government funding. Well, pretty much all of that comes to a standstill. standstill. You're talking about contract workers, you're talking about government officials. All of these people are no longer going to get a paycheck until Congress can do something with this debt problem. And a recent report from Moody's solidifies that, saying that around 780,000 Americans could immediately lose their jobs if the debt ceiling is not raised. And like I said, this has a lot of other negative effects for the United States as well, because it basically puts the validity of United States credit in the balance. A lot of other countries who want to invest in the United States, who want to bring businesses here, well, they're not going to do that if the United States has a credit problem. Not to mention, they're not going to want to take United States investment across the world if the United States continues to have this credit problem. So the bottom line here is this: the United States has managed to skirt past a recession, even though the Federal Reserve has been raising interest rates and our economy has slowed down a lot. But that doesn't mean that it necessarily is going to continue in that direction. I'm not here to say that it's definitely going to continue in that direction or it's not, but you need to be prepared for either scenario, and you need to know what to do with your money. Not to mention, if the United States defaults on its debt, if the United States has this inflation problem or goes into a recession, you have to be prepared with your skills and your experience. If you're somebody like me who makes their money from their 9-to-5 job, well, that means that you're going to have to continue to do that, and the only way to do that in 2023 is to continue to expand your skills and your knowledge, so that way you remain valuable no matter what the economic scenarios are. You can't control the economy, you can't control what goes on with your company, you can't control how the stock market or the federal government is going to handle its debt. But what you can control is your own life and your own finances, and now is the time to create a plan before things really go down. Like I said, preparing for either scenario. So you want to be prepared in case things go down and you can capitalize on opportunities, and you want to be prepared just in case things go up, because that's not going to hurt anything, right? What we can expect to see is consumers continuing to spend a lot less money because inflation is still really high in the United States. We are most likely going to continue to see corporations and businesses spend a lot less too, because they're not getting that investor interest and they're not getting any money from consumers. Profits continue to take a hit because of productivity and debt, and overall that is going to affect Americans and their jobs and their job security in 2023. So while things might look really good on the surface, something is definitely bubbling down below. And the question you have to ask yourself is, are you ready for it? That is it for me, everybody. Be kind out there, and I'll see you all in the next one.